It's not far off, Tom. You're right. Is it sustainable? Probably not. And the reason I say that, look, we're on track, even with probably a negative day today, to have the best month that we've had in 3 decades. In fact, if we saw a 1.5% appreciation today and also on Monday, it would actually be the best month in the ASX's entire history. So that would probably come back to my answer is sustainability is you do not see a 13.5% increase in a month without a pullback. That's more than what we normally average per annum rather than averaging per month. The other part of this question that probably goes a bit further than that and expanding out a bit further is that markets try and price, or at least under theory, they try 12 months ahead of time. Now, they're pricing in the idea that we will have a vaccine, or probably more likely multiple vaccines, that some form of normality, inverted commas, will probably come into fact over the next 12 months, not just here in Australia, but globally, and that economically we'll probably start to see things return. The question that goes from that, though, is that for what we haven't seen in the GFC to what we have seen during the COVID crisis is that fiscal, so government support globally, has been like nothing we've ever seen. If that, along with government, along with central bank support, doesn't actually generate some form of returns with regards to earnings growth, not just with listed companies, but the economy as a whole, private companies, little companies, your corner cafe, if that doesn't actually start to eventuate, probably starting in June, July next year, then all of what's going on right now will probably come under a real big question. So in terms of your question, and the answer to it is sustainable if we do see that happen. It won't be sustainable if we don't see a change, probably, as I said, midway through next year when that vaccination starts to see inoculation levels getting us back to normalisation.
Yeah, and I guess, look, there's always the prospect of money having to go somewhere, but will it flee the market? And housing pretty strong as well at the moment. Next quarter, of course, of GDP out next week. This is the recession watch.
That is the recession watch, Tom, and yes, it's out next Wednesday. Third quarter, the question everybody's asking, are we out of recession? The answer will probably be yes. We will probably be out of a technical recession. Now, that is not to excuse the fact that we will still feel like the economy still realistically is in recession. In terms of that feel, employment hasn't returned to pre-COVID levels. We haven't seen a scenario where realistically we've got growth in companies. We're seeing a growth there. But yes, next week's GDP is likely to show that. Consumption in the third quarter, barring Victoria, was really starting to move on the upside. Net exports will also be a part of that in terms of that better than expected story. If you look at July and August, they were the second and third biggest exports on value and on volume of iron ore. So net exports will be there. The other thing we know is that, JobKeeper, JobSeeker was incredibly strong during that period as well. So government spending is likely to also be a big, big part of why GDP shows that we're out of a technical recession, and a technical recession is 2 quarters of negative growth. So yes, we're out, but that doesn't mean that we are, actually getting better and seeing strength. We've just come from an incredibly low base and we'll get a quarter of growth. The question is it sustainable? Do we see the fourth quarter and the first quarter of next year also continue to grow out?
Well, that's the thing, isn't it? With that volume of assistance to come back down, we could be up, down, up.
Yes.
There's every possibility the way that sort of works, and I guess we'll start to look at year on year as well. Just finally, the story, of course, on the front pages is all this coal being blocked from entering China, Australian coal. So that's one side of this trade relationship. But when China needs it, doesn't worry about principle, and we're talking about iron ore and copper. They can't get enough of Australian red dirt.
That's right, or red anything at the moment. And so that's the other side of this. As you said, what is also astounding by this in terms of a value basis as well is that copper is now at its highest level since 2014. In fact, if it went another about $50 a tonne in London, so it's currently sitting at $7,325 a tonne, another $50 on top of that would be a record all-time high for the copper price. And copper in the US is about $3.32 a pound. That, don't forget, copper is our fifth largest exports. As you've already highlighted, iron ore is our largest, and it is about $70 above what the government was expecting on an average price through this year. So they are booming. We know China is booming. It also suggests that 2021 inflation might be an interesting thing. We always refer to copper as Dr. Copper because it gives you that very good gauge of global production, of global infrastructure spending, because it's used in so much thing with regards to infrastructure. And that is the standout story here is China is booming. We can't hide that in any shape or form. And therefore the demand for Australian bulk commodities outside of coal, and unfortunately outside of agriculture, is doing incredibly well. That needs to be put out there. And that's what may come through next week's GDP numbers, but also in the fourth and the first quarter of next year, is that they will continue to ramp up their demand for our product because they too are spending their way out of the COVID crisis.